This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we're very pleased to welcome on Tim Donovan with Midloch Investment Partners. And we're going to be talking about a topic that's near and dear to all of our hearts, which is commercial real estate, but more specifically, some things that are going to be a little bit more market specific, and really kind of looking at the Midwest multifamily real estate markets and a lot of other interesting aspects about this. As we all kind of, have been hearing about, and now we're starting to see it matriculate a little bit, the commercial real estate times they are changing. For the past 7 or 8 years, even, during that small blip in COVID, we really haven't seen a real precipitous change to the market for any, particular market segment. People could pretty much try to pencil a deal and it would pretty much more or less always work. And people were having the ability to maybe, push some things through that, now we're starting to see the cracks in the foundation, and also some opportunities for investors to come in. Just because certain things may be changing or certain people may be in trouble, it's always important to understand where the opportunity comes in that. As the old adage goes, especially in real estate, when there's blood in the street, buy property. Maybe we don't need to be as voracious as the Romans, but again, it does definitely kind of lend itself to looking at opportunity when there is distress in a market, because that's where, all of us are looking for value. It's the number one key goal that we're always looking for in real estate is where can we find value? Where can we find value, especially in saturated markets? And when we start to see a little bit of a cleansing of what is out there, it's going to create rampant opportunity. And we're really excited to kind of dig in that today. So Tim, if you wouldn't mind, give us a bit of background about yourself. Again, thank you very much for being on with us today, and give us a little bit of background info on yourself and your company.
Yeah, absolutely. And thank you guys for having me on. Exciting to kind of share a little bit about what we get to see in the market. So my name is Tim Donovan. I'm one of the managing directors at Midloch Investment Partners, as well as one of the co-founders. We're a Midwest-based real estate firm. To put it in what I kind of call layman's terms, we really operate as a real estate mutual fund. So for that, we have a fund model where investors, anywhere from individual investors to family offices and wealth advisors, will invest in our funds. We then go around the country, primarily Midwest focused, but we operate in markets all over the country. And we invest LP equity in apartment complexes, industrial buildings, retail, selectively office. And so we get to play across markets, we get to play across property types. And within Midloch, I really focus on the investment side. I kind of oversee our process everywhere from deal sourcing all the way through underwriting, due diligence, asset management, and then ultimately the disposition. So kind of everything start to finish on the property side. So excited to share some of the insights with you guys today.
No, absolutely. And excuse me, it's also kind of interesting to talk to people that have, different structures than, a lot of things that we're used to. We've had a lot of guests on here that are, and not for anything bad, but it is just a commonality a lot in commercial real estate. A lot of people that are kind of deal sponsors, they maybe run a commercial real estate syndicating firm where they, bring in different deals, they syndicate it, and a lot of them run extremely well. We're very lucky that our clients have identified and partnered with a lot of really great operators. But the model is relatively similar. You go out, find the property, pencil it out. Okay, here's what's going to work at, acquire financing, raise the capital, operate it, refi or sell. It's a proven method. But again, coming in from, someone from your perspective, maybe tell us a little bit about kind of, again, the position that you take with more of the mutual fund model where you're coming in as more of kind of like a broader LP or large LP position, and why that is something that you've gravitated towards. Because in our pre-call, you mentioned a few things that I'd never really kind of thought about with, especially leveraging those large capital positions. So maybe get into a little bit of that structure a little bit.
Yeah, definitely. And at the end of the day, a lot of times, the types of deals that we're investing in are oftentimes the types of deals that people are often looking at with regards to these syndication models. But we really are targeting a similar profile that we're coming in, to your point, with kind of one large check, investing with a local operator, like what we're talking about. So we've really liked that space. I mean, real estate is a very local investment. I think much more than a lot of times people will give it credit for. And so really what we've tried to do with our funds is we've really tried to create a vehicle that creates diversification for our investor base. A lot of times you'll see people who are invested in a given property type, a given market, a given asset, and that's great. But obviously, there's a lot of exposure to that one given market, that one property type, that one asset. And so, in order to try to combat that a little bit while also giving good real estate exposure, we've always gravitated towards that fund model just from the standpoint of you get asset class diversification, you get location diversification, you get operating partner diversification, all through writing a $100,000 check, right? Where oftentimes that's a little bit harder to do when you're investing in a specific property or a specific market with a group. Now, with that, and Alex, you kind of alluded to it a little bit, we also like that model because we would be an alternative to a group going out and syndicating money amongst a bunch of individual investors. But with that, because we're coming in as the anchor investor, oftentimes bringing as much as 90% of the equity on a deal, we have some real negotiating power with regards to fee structure, with regards to ongoing operations, all of which we kind of use as a means of aligning the incentives between the operating partner and our investor base. We see in a lot of instances, sometimes the syndication models, operators get by with charging too high of fee loads. Sometimes there's not an appropriate alignment of interests with regards to ongoing operations for what benefits the operator versus what benefits the investors. So we really use kind of our position in the deal not only to maybe negotiate fees down, but also on an ongoing basis to make sure that we sort of hold our operating partners to kind of the highest operating standard, really kind of acting as a checks and balances when it comes to kind of month by month, quarter by quarter, year by year performance at the properties.
No, that's definitely a great point. And I had a great guest as a local real estate attorney and a broker, but his kind of primary core focus is on like legal document and feasibility review for individuals investing in commercial real estate. So going through prospectuses, PPMs, and a good point that he brought up that really kind of lays into what we're talking about is the ability to, kind of negotiate some of those terms. Just because you get a term sheet doesn't necessarily mean that that's the end all be all of it. But they're not going to kind of cave or give any kind of concession to the lowest man on that rung. You need to have a significant capital position to really kind of flex to say, look, I like this, but I don't like it enough the way it's currently written. If we can tweak this, maybe let's reduce the load on this, or maybe let's, look at, something with regard to how this is going to operate. You get that ability if you're coming in the position you are. So I think that's, definitely an interesting way to look at it. And especially if you have the diversification play of saying, look, we're not going to necessarily be involved in the operation. We're taking strictly the more passive side, but allowing the clawback of some of that, operational structure by virtue of how much capital is being deployed into it. So, with that being said, what are some of the kind of things, at least from the market perspective, at least right now, and I know, you're very centric to the Midwest, maybe explain a little bit about why you kind of have gravitated, at least currently, towards looking at deals in the Midwest and and kind of defining that region of why you're focusing this type of structure into that area.
Yeah, no, and a great question, and I would tell you there's a lot of factors that play into that, but one thing that we really look at closely with any investment we make, right, whether it's apartments, whether it's industrial, whether it's office, we really sort of take a first and foremost kind of top-down approach, right, looking at fundamentals of what drives a market. And especially, I would say in recent years, it's been really supply and demand driven from a physical property standpoint, right? I mean, everybody talks about Sunbelt markets from a demand standpoint, but oftentimes overlook that supply follows that in a very serious way. But then we also really look at where capital is chasing at that point in time, right? And the more capital that there is chasing a space at any given point in time, the tighter the return metrics are in that type of space. And so I don't know if it's totally fair to say that we like to zig while the market's zagging, but to a degree, that's kind of what we've looked at, right? Is to say, hey, listen, we really like to take, I guess you'd say, sort of the slow and steady route, right? Markets that don't have a lot of volatility over time, mostly because real estate really is kind of a long-term play. And we've been primarily value investors, meaning we're trying to pay 70 cents for what we think is worth $1 today. We've never really been on that growth investment train, which would be, hey, we'll go pay a buck 10 today because we think in 5 years it'll be worth a buck 50. And I think that has primarily been the mindset of those Sunbelt markets, right? Is pay whatever price it takes, right? Get into these good markets with high growth. But then you sort of see in a time like this where the tides start to change a little bit and maybe supply outpaces demand, maybe rents start to pull back a little bit. You see some cracks start forming there, which is, I think, what Alex was alluding to a little bit earlier. That's why we've always sort of gravitated towards these Midwestern markets. Supply and demand has always been a little bit more in balance with one another. The amount of outside capital has not been so severe. So we've been able to find really attractive buying opportunities in markets that have really good fundamentals still.
Sure. And what would you say is kind of the the market segment that you operate in? I'm assuming it's probably mid-market, somewhere in the
Yep.
neighborhood of like 10 to 50, or is it like 5 to 45? Like what's kind of the median of like the deal size that you're looking to target with these?
Yeah, we say broadly, right, small to middle market. We position ourselves to be above the space that a high net worth individual might play in, right? A small little strip mall, a small little single tenant office building, a 12 family. But we play below the institutional capital space as well. So we kind of pegged that broadly as 5 to 50 million in
Okay.
total deal size. I would tell you realistically that band's probably a little tighter. Maybe I would say kind of that 10 to 30 really kind of plays in that sweet spot. It's properties large enough to have economies of scale, but small enough to still fly under the radar of competing with pension funds and life insurance companies and other institutional capital.
For sure, yeah. And so you brought up some things I really kind of want to drive down on of what drives the market. And again, living locally in, Florida and kind of seeing what's going on in the Southeast, it's, the classic economic model of supply and demand. There just is not enough supply to meet demand. And again, at least my humble opinion is that, the deals that were penciled on maybe kind of the thought of what's going to happen, the rose-colored glasses of what's going to happen tomorrow versus the reality
Yeah.
is of what's actually going to happen. So, it's going to be interesting to see, once but again, that metric's always going to be there. So many people are continuing to move and migrate to our area that I don't necessarily see where that crack's going to come.
Hmm.
We have this huge propped up market, but I just don't know which part of that dam's going to fail first, right?
Yeah.
It's kind of hard to tell because you still have this relatively constant demand for everything, but in supply, it's kind of funky down here. But again, I think looking at it from and maybe why is why you kind of focus on the Midwest because the economics are a little bit easier to identify, right? Those
Yeah.
kind of issues are a little bit easier to see. Okay, here's what we have going on, and it's not so much of like, okay, which one of these failure points is going to be the inflection for where it's going to be the
Yeah.
value created. So, when it comes to looking at your specific market, uh, where would you say that you have the velocity of capital going, or where have you kind of seen that create the opportunity? Has it been pullbacks? Do you look for the pullback, or do you look for the increase in velocity in a certain direction?
Yeah, a good question. And I think it can be a little bit of both. The hardest part about looking at the pullback, as I'm sure you can understand, right, is that the the timeless challenge of catching a falling knife. Right. And I think we're in that flux in certain markets. And again, I'd caveat all of this with real estate is so market by market dependent, right? Broadly speaking, there's still a housing shortage out there. But again, that's broadly speaking. There are certainly markets where supply has outpaced demand for the near term. There's certainly markets where demand is still way outpacing supply. So I think to a degree, I would say we tend to be in the near term still Midwestern focused, still maybe focused on markets where there's maybe more money flowing in. Obviously, that's creating further competition, which makes it hard to be a value investor in those space. But at the same time, too, exactly to your point, a lot of the markets that are seeing some of the supply pressures right now are seeing that because demand is still growing at a rapid pace, right? So fundamentally speaking, in the long run for a lot of those markets, there's still a lot of reasons to be there. We're just in this weird kind of interim blip where we may have a 24, 36-month period where supply outpaces demand, where rents start to soften and where occupancy starts to drop slightly. But at the end of the day, especially with the rise in interest rates, development has by and large slowed down dramatically. And we're going to hit a point, to your point, Alex, where people are still moving there. But if very little new construction was done in 2024, 25, 26, we're going to hit a point on the back end of this where you're still going to be undersupplied in the long run.
Yeah, and I think that's one of the kind of interesting economic factors about this is that you have these interest rates that maybe kind of, you know, quench a little bit of the development aspect, but then that's inherently going to help to prop up the market from
Hmm.
that supply demand curve. So again, I've been involved in this for almost 13 years, and I've seen, again, I haven't really seen any type of huge market correction. We've seen some in the beginning of the first Obama or the second Obama administration, and certainly coming out of the Great Recession when I first kind of got my career started in this kind of area. But yeah, this is kind of a new one for me, and it's
Yeah.
interesting to see it's a new one for a lot of people, even some commercial real estate developers that I've talked to that are old enough to be my dad. Are even like, yeah, this is kind of a new one for me too.
Yeah.
They've seen the traditional stuff, whether it's, rates or geopolitics or, X, Y, and Z happen. But this kind of interesting, inflationary metric versus like coming off of what's been happening is kind of interesting to look at. But not to opine on again, I think the fact that everyone can agree that yes, these are interesting times to be an operator in, um, is, looking at the specific markets. So let's again drill down a little bit. We say Midwest, that, we live in the
Yep.
fourth largest landmass country in the world. So when you say Midwest, are you like drawing the line at like Ohio over to Minnesota and then down to Tennessee? Like where is kind of like the geographical location where y'all are kind of focusing your efforts on right now?
That's a great question. We have a lot of fun internal debates of what even is the Midwest, right? I always like to say I sort of view Pittsburgh as probably the farthest east in the Midwest. Maybe people there would disagree with that, but I think, right, there's probably just as many similarities between Cleveland and Pittsburgh as there would be a Pittsburgh and a Philadelphia, right? So I kind of view sort of Pittsburgh, it maybe going west from there to the south, kind of probably roping in Nashville as maybe the farthest southern market. And maybe that's a little bit of an anomaly just because they probably have some of the capital pressures and supply pressures that some of the Sunbelt markets might have. And then this is probably my hot take for the day. I always loop Denver in of being kind of the farthest western Midwest city.
I know
Again,
they would
I'm
disagree with
I'm
that.
sure they would disagree with that. Right, but that I would say kind of basically Rocky Mountains east. Um, right, I mean, but when we really talk Midwest, we're really kind of referring to, right, the Ohio markets, Michigan, Wisconsin, Minnesota, Illinois, Iowa, Kansas City, kind of Missouri, Kansas. Those as being kind of those core Midwestern markets that we're focused in.
Okay.
Indiana, obviously.
Yeah, no, it's just kind of good again to kind of give an idea of it, especially for people trying to maybe get a justification for how this strategy kind of works. Now, we talk about, interest rates again being the hot button topic, but there's kind of, at least in my opinion, a few different ways to look at how interest rates are affecting maybe the immediacy, but also, what is going to happen to deals that have already penciled. And I think that's
Yeah.
what maybe people don't necessarily give enough credence to for where the value is going to come is the operators in deals that maybe otherwise, you know, pencil them with some very, very bold assumptions about what was going to be happening with interest rates. So let's talk about a little bit kind of the immediate term. We've
Yep.
seen interest rates drop a little bit. I would say they softened. We
Yeah.
haven't really seen a drop, but we've seen a kind of a softening. And from the position of the Fed, again, looking at that, granted, what CPI came out on Monday or Tuesday?
Yeah. I
And
think
it
yeah,
showed a
Tuesday.
little bit of an increase. It didn't effectuate as much as they thought. So maybe we'll see either another freeze or we might see an increase.
Yep.
And it's also hard to tell with a new administration coming in what's going to happen with that.
Right.
No matter what side of the aisle you belong to, you can just agree that something's going to happen.
Yep.
What that is, we will see. But again, what are some of the things again for navigating kind of, and maybe it is a kind of a mixture of those things of where you're looking for that value from the cracks in the foundation of these certain
Yep.
deals versus other things that don't. So maybe let's get into kind of again the interest rates and the different facets of how that kind of affects your investment trajectory in your markets.
Yeah. The interest rates is a really interesting subject because obviously I would say more so than anything else, that's probably creating the most volatility right now. And it's kind of from a couple different angles. And I think one thing that's worth noting that I think a lot of people lose sight of a little bit uh, is the Fed and their lowering or raising of rates certainly has an impact on certain portions of the real estate market, right? But what they do in the near term on short-term interest rates doesn't necessarily one for one correlate to what you can go and borrow from a bank from, or what you could go borrow from Freddie Mac or Fannie Mae, right? The government agencies. And so, well, we certainly keep a close eye on overnight rates, right? The Fed funds rate, which more closely ties to SOFR, which a lot of floating rate debt is pegged off of. We really look a lot at sort of the 5, 7, 10-year treasuries, which those operate independently, right? The Fed, outside of maybe what they say at the end of a Fed meeting, they really don't have a lot of control over those. And so, while we certainly like to see the short end of the curve coming down, I think what you're seeing is a little bit, Alex, to kind of what you've talked about, is maybe some inflation that's a little stickier than people thought. And I think that's keeping that 5, 7, 10, kind of that mid part of the yield, a little higher than anybody ever really thought it was going to stick at. And I think that's the part of the curve that's really causing the pain right now. Right? It's one thing if in the near term your floating rate debt and your short-term borrowing is expensive, but if you can't refinance into inexpensive fixed rate debt, I think that's where people are really getting pinched right now. And it's causing a problem again, like I said, on the refinance space. I think a lot of the challenges, which also flows into the opportunities, right, is it's people who either acquired value add real estate with floating rate debt, right? To your point, Alex, right? It penciled really well when SOFR was at almost zero and their interest rate was 3. Now SOFR's around 5, right? And now your interest rate's closer to 7.5 or 8, and the economics just function differently, obviously. So it obviously has a big impact on that. It's causing some pain in that space, but it also hurts on the new construction side. People who maybe began developing something in 2021, 2022, right? They were underwriting kind of a low threes to 4.5% interest rate on their construction, and now that's doubled. And now not only did you potentially have some inflationary pressures on your construction, but you also had increased interest rates, which caused your carry costs to go up. So that's happening a lot on kind of the existing product. But then on the flip side, on acquisitions, it's becoming more and more challenging. Cap rates have certainly gone up to accommodate higher interest rates. But from my perspective of what we've seen to date, I don't know if cap rates have gone up quite enough to compensate you for how high interest rates have gone. Right? Even in today's environment, right, banks are still lending out at 6.25% to probably 7%. If you're lucky and you qualify for government agency financing, maybe that's 5.25% to 6%. But by and large, the higher rates are also sort of what's driving this bid-ask spread between buyers and sellers in today's markets, where sellers still want to sell their deal at a cap rate that's justified by 4% debt. But a buyer now who's getting term sheets from their banks at 6.5% need to pay a price that's reflective of that financing. And if you're not really under the gun to sell your deal, you're getting this kind of stalemate between buyers and sellers.
Sure. So where do you kind of in that scenario find the most value for either the acquisition, or do you even come in as sometimes like a, kind of the I don't like the term bailout, but kind of the step in replacement or additional capital? Like where do you kind of see the value add for what you're doing? I mean, value add again, just to kind of define my question for people listening, not in the necessarily the traditional sense of saying, okay, great, well, if we, add, better parking and better amenities, not necessarily value add like that, but the value to the core of the deal coming in from some of these market pressures. So from what you kind of just alluded to, where do you see kind of the best, and maybe it's a few different areas too, but where do you see these kind of pressures from interest rates creating the most value for the new investments you're making?
Yeah, sort of like a risk reward balance, you're sort of saying.
Yeah.
Yeah, it's kind of coming in a few different areas, and again, I mean, our main business is value add acquisitions, right? It to be able to buy an existing deal, create value, sell it. I mean, that's really our space. But to what I just said, obviously, that the bid-ask spread and the prices are still making it challenging to do that. And so what we're sort of seeing is, in our opinion, in many of the circumstances that we look at, you're taking on just as much, if not more, risk for the same reward on acquisitions right now. And it's market dependent, it's deal dependent, but more so, it feels like you're taking on a little bit more risk to get the same return as you did a couple of years ago. And so, in a lot of instances in the near term, I think at least until opportunities flush themselves out a little bit, we've been looking a little bit more at what we kind of look as that preferred equity to sort of help fix slightly broken capital stacks. And that kind of comes in two forms. I mean, we've looked at it on new acquisitions, right? Properties that we like where potentially it's challenging to get traditional financing because banks have pulled back loan proceeds. Obviously, higher rates mean lower loan proceeds, right? So maybe opportunities where 2 years ago someone could have gotten 70% loan to value financing. Now they can only get 60. So maybe we can come in a preferred equity position to bridge that gap between 60 and 70%. But we're finding in a lot of instances you can get paid between a 13.5 and a 15% annualized return for that part of the capital stack. It's property dependent, it's market dependent, but from our perspective, because of the dislocation in the financing market today on those new acquisitions, there are times where you can get what we would kind of view as maybe the lower end of the value add return spectrum, but in a significantly more secure part of the capital stack. Now, I'd say maybe the other side of that then is a little bit more on the, if you want to call it the rescue capital, right? It's the deals that are facing kind of loan maturity problems, deals that are facing debt service issues, using that same mechanism, right? Some level of preferred equity to help right-size loan amounts, to help refill balance sheets to get the deals to kind of that next stage. That's the other side of things is looking at these deals that are facing some external pressures and say, hey, it's a property we like, it's a market we like. This deal just happens to get stuck in kind of a challenging moment in time. But can we kind of come in a preferred position? Maybe in our eyes, it's a little bit less risky than as a common equity investor. And can we help kind of buy time and get the property back on track?
No, that's a really interesting way of looking at it. And one of the things kind of in our pre-call that I really wanted to make sure we touched on was the understanding for a lot of people of commercial real estate syndications, limited partnerships, again, is kind of twofold, right? You have your passive limited partners and you have the active GPs, right? It's, again, everyone kind of understands that it's kind of like your 101 introduction to commercial real estate is at least understanding, who the players are in this and what you're actually buying. But preferred equity really isn't something that people hear a whole lot of outside of the more traditional securities realm, right? Preferred stock, common stock, interchange equity in there, and it's basically, same.
Yeah.
So when it comes to this, and again, this is something that I find very interesting about what you're doing, maybe give a little bit of, again, kind of an introduction definition of when you say coming in as a preferred equity position, what does that mean? And what exactly does that offer to you besides just, you kind of, get rattled off the, the rates of return you're looking for, but like, what does that mean as far as, again, where that fits in the capital stack and how that pays out against what you're actually putting out there?
No, a great point. And it's, again, it's a space that really prior to a couple of years ago, you never really saw much, right? Debt was cheap and equity was readily available. So the need for preferred equity really didn't exist, really up until probably the start of 2023. And so when we talk about preferred equity, and again, I make the caveat of there's a million ways you can structure it, but I would say a pretty common way that you see a lot, right, is that it fits somewhere between the senior mortgage and the true common equity LP, right, passive LP investors and active GP investors in the deal, right? It is the senior loan always gets paid first, but then a lot of times you have with preferred equity kind of two different parts of it. You have what they call the current pay, and you have some type of accrual function, right? So maybe what happens is cash flow from the property first goes to pay the debt service for the senior lender. After that's paid, it owes the preferred equity investor 8% on their money, right? And then maybe after that 8% is paid, anything left over goes to the common equity investors, right? And so you come first in the event that there's not enough cash flow you get paid before the other common equity investors get paid. And then same thing happens at the time of a liquidation event, right? You go and you sell the property, right? First and foremost, the senior lender gets paid off. Then the preferred equity investor gets paid off, and that's where that accrual piece comes in. They get their original investment back, right? Maybe it was an 8% current pay that you've been getting paid every month or every quarter. Maybe you had a 6% accrual, right? So an all-in return of a 14. You get your original investment and you get your 6% accrual back. And then once you've received all of that at the time of a sale, the common equity investors start getting all of their money back. And so it puts you in a position where you kind of both on terms of cash flow and in terms of a liquidation sale, you have priority in terms of the waterfall, if you want to call it that, right? The order of repayments. You get priority over the common equity investors, which in our mind puts you in a safer position. But at the same time, you also have to look carefully that there is common equity ahead of you, right? At some point, right, you don't want to be preferred equity if there's no money ahead of you, because at the end of the day, your return's capped, right? Once you got your hypothetical 14 in this scenario, everything else goes to the common equity, right? So if the deal does really well, you get your 14 and the common equity gets everything else. The deal does just okay, you get your 14, the common equity gets everything else. And so we like it because at a time like this, where it feels like there still is some risk out there in the market, it allows us to, again, achieve kind of our good cash flow, a good value add level return profile. But in our mind, that's also sort of taking our foot off the risk pedal a little bit.
Yeah, and would you say it's a fair assumption to say that the kind of the surge in this type of equity model is again pretty much driven by that delta between the bid ask on the buy sell for these things, and if we get a little bit more of a squeeze on that and we start to come in line with like a more again realistic bid ask for the marketplace, that it's going to basically become more advantageous to kind of go in as that sizable LP venture. Again, it's
Yeah.
this is something that again is not necessarily kind of a long term strategy. Well, I mean, I'm sure it would probably still be, a part of
Yeah.
the general thesis of what you're doing, but it more or less kind of again just fills that, the hedging of that risk profile. Is that a fair assumption?
Yeah, I think that really kind of hits the nail on the head, right? Especially when it comes to new acquisitions, where, right, the reason you only can get 60% loan to purchase price debt is because your purchase price is still high and your debt cost is high, right? And so the fact that you need more equity is more of a function of the price that you're paying than anything. So exactly to your point, right? Once the price starts coming down maybe a little bit more, or to what you're saying, the bid-ask spread tightens, right? The need for that preferred equity to fill that gap may be gone, right? And then to that fact pattern, you can get more traditional leverage points from your senior lender, and it makes more sense to become a common equity investor again.
Sure. And from the perspective of the general partners in this, what would be, is it mainly just for the fact that, it's tough, it's very hard to refinance at rates that kind of meet your prospectus in any meaningful manner right now, if not impossible, but also the fact that it's more appetizing to their common investors to not just call a ton of capital from them and just bring in the superior equity position. Is that again kind of how they're viewing this in that space?
Yeah, it's kind of, I would say, mainly twofold. One of which, to that last point, right? I mean, it's to bring 40% equity is a lot, right? And obviously, the more equity you're bringing to the table, the more mouths you have to feed with the cash flow at the property, right? That brings your returns down a little bit, right? So it's hard to hit old levels of returns now that you have to bring more equity to the table. It's also harder to just source equity in today's environment. Obviously, there's a lot of kind of uncertainty in the market, so just sourcing equity is already challenging, albeit more equity than you ever had to. But then the other side of that coin is depending on the performance of the common equity, preferred equity can still be very accretive to the deal, right? If you're an operator and you truly think that your common equity is going to return a 20% annualized return, and someone's willing to take 10% of your capital stack at a fixed 14% rate of return, that still is accretive to your investors at the end of the day. So not only does it fill that part of the capital stack, but because it's sort of a fixed rate of return, provided the deal outperforms expectations, it actually can still be accretive, no different than senior debt to the common equity investors.
No, yeah, that definitely is a really interesting way of looking at it. And I would say further to that, and again, I wouldn't imagine that, just like nothing in, and that's one of the nice things about real estate. Nothing in real estate is static. Ideally, besides just the asset on the ground, you
That's
don't
the
want it
goal.
torn off by a tornado or like we're down here in Florida, massive hurricanes that hit within a week of each other.
Yeah,
Oh
right.
man, it was rough to be down here in Florida. But the dynamic aspect of our market is one of the reasons why a lot of us do what we do, right? It's the reason I've been doing this for so long is that, I sit down at my desk and I get to see different stuff every day. And even the same stuff that I see changes over time to a pretty meaningful degree. But with that said, it's again, I think, the current lens that we're looking at with this preferred equity model is interesting because it definitely fills a very needed position for otherwise good deals that are just getting squeezed by this market to give some breathing room and also allow for, again, more capital to flow into this and people like you or other investors to make money. But do you think that there's a would be a potential for this type of model to kind of come into newly structured deals where you have LPGP and then maybe some type of preferred equity part that's already offered at offering? Or do you think again this really is just kind of a, break in case of emergency, not to be too crass about it, but again, it's there's a reason why this has made a surge in the market right now. Or do you think, again, this will probably fall pretty well off once things, again, that bid ask starts to get a little bit closer to reality?
I think to a degree, my personal take is it's still going to fall off a little bit as soon again, right? As soon as inexpensive debt is more readily available, it's obviously better off to take a 6% loan from a bank than it is a 14% preferred equity investment from a group like Midloch. Um, but at the same time, too, we're still seeing it on new acquisitions as well. And again, I think the big reason behind that is maybe not that deals are broken or being pinched, but again, that it's challenging to find financing these days, right? Whether your deal is distressed or not distressed, banks are being ultra conservative, life insurance companies are being ultra conservative, right? Government agencies, Freddie, Fannie is not available to commercial borrowers, right? So, for example, we have a preferred equity investment on a really great retail center in Salt Lake City. It was a 2014 vintage Target shadow anchored retail center. The GP on it came to us and said, "Hey, 30 days prior to closing, our lender pulled back a couple $1 million on our loan proceeds for no real reason, right? Rates weren't moving much, but whatever was going on at that bank at that moment in time, they cut loan proceeds and they said, "Hey, we got to fill that somehow." And we said, "Hey, listen, we can act quick, but if we're going to act quick, we've got to be preferred equity here." Right. And so we came in and we plugged that gap, right? They had already raised all the money. They had already had their bank line up, and all of a sudden those proceeds shrunk, and we said, hey, we'll fill that gap kind of in the meantime, right? That was a new acquisition where preferred equity played kind of a key role in getting the deal over the finish line. Same thing, we've done that on a kind of a newer construction multifamily deal. It didn't yet qualify for agency financing because it was still undergoing lease up. So they were buying the deal with a local credit union. The local credit union didn't really go very high from a proceeds standpoint. They had their common equity raised, but still had a gap between where the credit union would go and where they had common equity raised. So we said, listen, we'll come in from a preferred position. You'll get the property stabilized. You'll take it to a Freddie Fannie refinance, and then that'll give you an opportunity to pay us off of the deal, right? Kind of a short-term fix on an acquisition to kind of bridge kind of that gap. So there's a lot of still interesting instances where it's being applied in acquisitions. It's definitely not just in the rescue capital scenarios, but again, I think one way or another, my personal sense is it's sort of a short-term thing, even in that space. Because again, as soon as lenders are able to give higher proceeds, I think that's a better option than preferred equity.
Yeah, and especially, I mean, I would imagine, coming from the, wants and needs of the, common equity people, I mean, dollars to donuts, I'd much prefer it if my partner didn't have someone in
Hmm.
front of me getting paid. It
Yeah.
dilutes my interest and my potential returns. Granted, it's nice that, in the waterfall, basically, I can kind of get an unlimited cap to a point, and,
Hmm.
the preferred is going to be capped at a certain point. But especially, and there's definitely I think the value at 14% is definitely that nice hedge for someone like you. But, from the limited partner standpoint, again, I want that to come to me. I'd
Yeah.
rather that debt get paid off and then, let that waterfall come down, man. So it's definitely interesting. And I think again, it's one of those things where, I can see kind of two perspectives of people. If you're existing in, a deal and they're bringing in, some type of preferred equity, I think it's again good to understand what it is and why. If your deal sponsor is doing it, it's probably because they understand it's much better to probably do that than get some type of really egregious like short-term financing deal done,
Yeah.
right? Like you could probably find someone out there that will do a very sizable loan, but you're going to get, the vig on that is going to be massive. And
Yeah.
having something to where you can bring in someone that probably knows what they're doing and also have a capped return on it. I think at least, if a deal I was invested in was in the position that they had to bring in preferred equity, I think I would be much happier with that position, right?
Yeah.
It's again, it's just helping people to understand, one, the benefit of coming in on the investor side with someone like Midloch doing it, saying, yeah, that's great, that's how you can capitalize on this. But also, I like to bring the other side of the coin because we have plenty of investors that listen to
Yeah.
this and saying, look, if they're bringing it in, understand what it is and why it's being used, and it might honestly kind of maybe make you look at your operator in a little bit of a better light than
Yeah.
kind of just like pulling the ripcord and being like, like taking a perspective that is objectively more analytical. I think I kind of like where that's headed.
Yeah.
So, from the perspective of what you're looking at, let's look a little bit to the future. Again, this is again where everyone's like, all right, the questions on the future that no one knows and only can offer,
Yeah.
um, guessing answers. But at least kind of looking at, from my perspective, coming into this year, I thought we were going to see much more precipitous changes than we did.
Yeah.
We had, you know, interest rates up, 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 and then we start seeing a little bit of a softening. And everyone's kind of like going, all right, great. But I didn't really see as much of a kind of running to the deal table as I thought I would. And I couldn't necessarily figure out why, at least in my market, looking at again that delta is still there. People are still trying to get top dollar. So, from my perspective, it's like, so do they still see that there is the ability to capture this amount of equity out of the property? Or are they still just holding on because they have to, they're really underwater on it? Or am I just missing something? So, what do you think it's going to take to kind of really get us over the finish line of a true market correction? Because it's just been, it's like, I think it's going to act like water out of a bucket and it's kind of like maple
Yeah.
syrup, right? It's just
Yeah.
not
Right.
moving as fast as I keep thinking it's going to for all sorts of interesting reasons. But at least going forward, what do you think is going to kind of get us past this kind of sticking point in the economics of where, again, we're going to get that decrease in the delta between bid ask. We're going to get, people being able to acquire financing and kind of getting back to the more traditional model of buy, sell, finance, refinance, kind of again what we're used to. Or is that gone? Do you think we're kind of permanently in some type of new situation with our markets?
Well, I hope not the last part. I can't imagine that's going to be the case, but no, we're at a really interesting point to your note, and I felt the same way. I figured this was going to be the year that, right, things really start to kind of fall apart, great opportunities show up. But I think there's a few different things at play. I mean, there's still a lot of people who own real estate that are under no pressure to sell their deals, right? They don't, and again, unless you've got some level of fund level mandate, unless you've got an investor breathing down your neck to sell a deal, or unless you've really got a loan maturity, um, there's not a lot of other pressures to be forced to sell a deal. And I think the reality is there's still a lot of discussion that rates are going to come down, right? And so if that's the case and that's the belief, then there's really no reason to sell today if you don't have to, right? If rates come back down, then you'd probably be leaving money on the table today unless there's some other external circumstance to do so. And so I think just because of that, you've seen deal volume fall quite a bit of people saying, you know what, my deal, maybe it's ready to sell. Maybe I was thinking about selling that in 24, but rates never really came down the way that I thought. Maybe it's going to sell for a six cap when I really want a five and a quarter, right? So I'm just going to wait and see, right? So I think you're seeing a lot of that, of deals that would have organically traded otherwise, but just given the stickiness in rates, they're just voluntarily holding out for longer, right? And we see that in some of our deals where it's like, you know what, kind of that buy sell analysis, or sorry, buy hold analysis. You say, gosh, I'd rather hold this at my current basis and my current cash flow in my current loan structure than go take it to the market today. Um, Now you've got the other side of that that are deals that are kind of going sideways a little bit or have gone sideways. But I think what's maybe underappreciated is that there's a lot of lenders that are still being very gracious with their borrowers here, right? Giving 6-month extensions, 9-month extensions, really not throwing the hammer down when kind of a minor covenant is broken in the loan documents, things like that. And so you're certainly seeing some of those types of transactions, right? Kind of debt forced sales occur, but really not at any kind of scale. And I think that that is going to be kind of that maple syrup trickle for the next couple of years. There's a lot of great articles out there on the wave of maturities or the wall of maturities. Um, right? And you start thinking back in time, right? A lot of these deals were put in place in 2021, 2020, 2020, 2021, even 2022, right? Those were put on with 5-year loans, even if they were put on with 3-year loans with some extension options, right? We're really just seeing the very early stages of those in 2024. Really, it's the 5-year loans that happened in 2021. Those don't really come due until 26, right? And so there still is a lot of time for those deals, provided those lenders aren't getting aggressive over loan covenants, that there's still a lot of time for those deals to work themselves out. So my personal 2 cents is I think I think the big key is rate normalization, right? Rates don't have to necessarily come down. They just need to stop ping-ponging up and down 50 basis points every 6 months.
Right?
Right? As soon as there's clarity of what the future interest rate environment may look like, I think that's when that bid-ask spread tightens, right? Because right now, I would like to pay the price reflective of being able to borrow at 6%. And the seller who's got that deal, who really doesn't have any pressure, they want to sell it at a price that at an interest rate environment that they're hoping that comes in 2025 or 2026. So I think the big thing is interest rate stability, right? I think that kind of unlocks the organic market, right? Normal buyers and sellers transacting. And then I think the other side of that is there's going to be this kind of slow bleed and slow recapitalization of the deals that are facing some really challenging loan maturities over the course of the next 12, 24 months.
Yeah, and I think one thing, and I would really like to figure out how to get this data of looking at closed and finance deals from, let's say, like 18 to 21, that basically, or let's say like 17 to 2021, where you have these people coming in pretty awesomely favorable market rates that have the ability to run through and then refinance to long-term low interest debt that, maybe their operators were getting a little spooked by like everything crazy going on and just didn't want to offload. So seeing like the correlation between how many of those properties that were closed within that time period have actually matriculated back to the market, because there
Yeah.
might just be a lot of people out there, and that might be again some of the more institutional space that maybe just has really favorable terms that got to get that great increase, rent rate increase, and really juice their cash flows. That are like, I don't want to sell. This is going crazy. So maybe that has something part of it to do. Again, I would. That's probably not the hardest thing to look at, but that would be kind of an interesting metric to
Yeah.
look at and see which one of those again have kind of come full circle through the market again, and then are maybe in a worse position than they were.
And
But I
those are
would
the
have to
deals
believe that
right
there are
now.
some people like that.
Those are the deals right now that if something is trading, it tends to be something that was bought pre 2020,
Mhm.
right? That was the kind of the pre-COVID, right? The pre-rate drop. I mean, I remember deals that we were doing in 2017, 18, 19, right? You were underwriting a 6 cap as an exit,
Mhm.
right? You could hit that today, right? You probably could hit your pro forma pricing if you took a deal to market today that you bought in 2017. Right back then, you were paying prices reflective around more of that 5% interest rate, and so right, the idea that rates went from 5 to 6 is not really that critical in your pro forma at the end of the day. It's those deals that got priced when the really hot markets were pricing at a 2 cap, a 3 cap, a 3.5 cap, right? That raise from that up to 6, that's where you see the challenge. And I mean, we underwrite probably 750, 800 deals a year internally. We probably only do about 8 of them. So we don't have a high hit rate, but we see a lot. And I mean, back in those days, the 21, 22, the number of deals that had a 4.5 exit cap on it, right, was incredible. And that's where you're really seeing this sticking point is deals that they thought would sell at a 4.5 cap. They haven't hit the NOIs that they projected, and now the market would say that's worth a 6 cap. Those are the ones that are really kind of sticking. To your point, all those deals from 17, 18, 19 oftentimes were just bought in a more normal environment. And so in today's world, you can still sell those for a good profit and make sense of it.
Yeah, and also to speaking to the, looking at your exit cap on that, you also don't have much like internal pressure to do much. You're not
Yeah,
going to have all of your investors barking down your door and be like, "Hey, we need to sell this." It's like with market uncertainty becomes people realist your investors really focusing on stable cash flow. And if you
yeah,
can provide that, again, we oftentimes get too focused on the end results like, hey, what was my exit cap, hey, what's my
yeah,
total IRR, but there people often overlook the security aspect of stability,
yeah,
factoring that in from the more retail side. Again, if you're on the investment profile side, someone like Midloch, not necessarily looking at that, but the stability from an investor standpoint to say, hey, look, if I can make an IRR of 15%, 10 to 15% of my money through all of this crazy stuff happening, well, I'm gonna, if we have an investor meeting, I'm gonna be like, hey, look, unless we can really, really hit a home run, let's stay the course. Like we don't need to
totally.
do anything. Give me give me those checks and let's continue to kick it down the road. So
Yeah.
um yeah, it's just there's so much interesting stuff going on with it that it's exciting to be in real estate right now. I hopefully hope there's like two camps of people. It's like people that are really excited to be in real estate right now and people that are really excited to maybe get out of real estate right
Yeah,
now. Hopefully you're in the former camp because
that's
there's a
right.
lot of opportunity even in the single family space and so many different spaces. There's so much opportunity that's coming on board that it's just got to make sure you're positioned right and are liquid enough to take advantage of the deals when they
Yeah,
come along. And hopefully align yourselves with people like Midlock who can help
yeah,
to plug into those spaces. So I think we've covered a lot of great stuff. I always love talking with people that are passionate about real estate and especially that are knowledgeable in different and new areas, especially things like preferred equity, which I will say right now we haven't had anyone talk about that to any
yeah,
meaningful degree on the podcast. So again, really appreciate you coming on today to elucidate to that and help educate and bring people's attention to a new method of investing for this. So
yeah.
are there any kind of closing thoughts or anything that you'd like to kind of bring in for a landing that we touched on that you had a few more thoughts on?
I mean, I would just say broadly speaking, I think we still are really optimistic about the real estate landscape, right? And I think the beauty with real estate, as every investment class, right? Regardless of the market, there's always opportunities, right? It's just making sure that you're really aligning yourself to really protect your risk, right? Protect your downside. That's rule number one. Um, but again, especially at a moment like this where there are some cracks forming, that's oftentimes where the best opportunities are. And I'd say the biggest thing that we really focus on that we really tell investors to do is really just stay nimble at a time like this, right? Kind of keep your eyes wide open, look at what's in front of you, and be willing to kind of shift and pivot as the market kind of continues to shift and pivot. And so it's exciting. It's a time we haven't seen for a long time. But at the same time, too, I think all of the volatility is opening up some of the more interesting investment opportunities that we've seen in the last couple of years.
No, absolutely. And it's very reminiscent of when I kind of came into my career when it was just like hammering all the big banks to buy REO bankroll properties.
Yeah,
Like it was just throwing, there were days where I would sit with clients and we'd just throw, 15 offers at Bank of America, another 20 at
yeah,
Wells Fargo, just constantly throwing stuff at the wall and just, again, praise be whatever that doesn't happen again. But
yes,
again, when there's turbulence, it creates opportunity. And ideally, hopefully, it doesn't happen again. But just, again, to your point, stay nimble, understand where the opportunities are going to come, and, you'll be able to reap the rewards. So if
yeah.
people are interested in learning more about Midlock or maybe getting plugged in with your investment opportunities, how can they reach out to you?
Feel free to reach out to me personally. My email's tim@midloch.com, tim@midloch.com. Otherwise, visit us at midloch.com. You're able to submit inquiries right there. Our investor relations team is able to reach out to you. So whether it be through our website, emailing me, any of those work, and happy to share my contact information with anybody who's interested.
Fantastic, Tim. Well, again, I really do appreciate you being on with us. The most valuable asset we all have is our time because we can't make any more of it no matter how well we invest our capital. So, again, thanks for spending about an hour with us today to chat. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.